All right. So welcome Stock Market Mastery Program. This is your last and final week. I just want to congratulate all of you for getting it this far. This course has been very intensive in regards to a lot of the content, but I just want to reassure you that the course material is not meant for you to just consume, digest, and all of a sudden you know all of these skills and know how to implement them right away. I've shared with you guys throughout this course. Think of it like you're learning how to ride a bike. And this course is meant to be your training wheels. And you're going to have to revisit a lot of these different sessions, whether it's fundamental analysis, financial analysis, so that it becomes secondhand, just second nature to your mindset about how you look at companies that you want to invest in. And so with that being said, again, this is our final session together. There's going to be more content that I'm going to be releasing. It's just not going to be live. I'm going to pre-record things for our investor group on Facebook, just to give you guys, continue to give you guys value, continue to give you guys valuable information that can impact your investing decisions that would in turn ultimately get you better results. And so I'll be continually releasing content through the Facebook group, and I'm active on the Facebook group. And so always feel free to make posts there. And whenever I get a chance, I will respond to those things. I'll respond to everything, but it just may take a few times. It may take a few days for more intensive things. Like if you need like a second pair of eyes for analysis, that may take me maybe a couple of weeks. Just depending on my life situation or how busy I am during that season. But again, this is a family. I hope that you guys feel more connected to one another over these last few weeks, and that you would, again, stay connected with each other and feel free to bounce ideas off of one another and whatnot. So tonight's session, we're going to be covering, we didn't get to cover it last week. I moved it to this week because I think it's a very important concept to talk about, because this is where the money is made at the end of the day. And so we're going to be talking about portfolio construction and portfolio management. Very important. So how do you really construct a portfolio that is going to perform well over the next 3 to 5 years, over the next decade, 2 decades? How do you do that? How do you construct it brick by brick? It can be kind of overwhelming at first of being like, okay, I learned about stocks. I know how to find good stocks. But how do I then build this really like this ship, and how is it going to sail and make profits for me? So we're going to be talking about portfolio construction. Then we're going to be talking about portfolio management as well. How do you manage a portfolio? The goal is that you wouldn't have to spend much time at all managing your portfolio. The most time that is taken up is during the research and portfolio construction phase. You're doing a lot of research on different companies that you're potentially interested in. You're researching industries that you want to be a part of. And then when you begin constructing your portfolio, and once it's been built, the management part, that's easy. That's the easy part. And so just know upfront that the portfolio construction, that's where time, it's going to require homework for you to be able to research and do analysis on certain companies. And again, this is so worth it, because the more that you begin to learn how to research, the quicker you'll be able to learn how to do it. And ultimately, at the end of the day, you're going to know how to use your money to make money for you. And your money is going to be able to grow instead of just sit in a savings account and rotting away doing absolutely nothing. And so portfolio construction, very important topic. Let me open up my slides and we'll get into it. So, all right, here we go. Session number 6, portfolio construction and management. So the first thing that we have to talk about is the different types of portfolios. People are in different stages of life. There's people who are close to retirement. There's people who are young. There's people who need their money in the next 3 to 5 years for a down payment on a home. And there's other people who can let their portfolios ride out for the next 5 to 10 to 15 years. And so there's different types of portfolios that better match each stage of life that a person is in. It's very foolish to try to create a cookie cutter portfolio for everyone. And so it's very difficult to get substantial gains when you kind of just do a cookie cutter portfolio. And the reason why a lot of fund managers and mutual funds, they're not able to get more than 6 to 9 to 10% a year for their clients is because they're trying to meet everyone's needs. And so it's very difficult. But the benefit that you and I have is instead of paying a fund manager, instead of buying into an index, is we're creating our own portfolios. First best thing is that we don't have to pay people. We don't have to pay people an average 1.6% to manage our money for us. If you have a $100,000 portfolio, that means you're paying someone $1,600 every single year to manage your money. And so the benefit of you and I being able to manage our own portfolios is that we can not only get greater returns because we now know what we are doing, but we also don't have to pay people to manage our money for us. And so there's a lot of benefits to creating your own portfolio. So let's look at the different types of portfolios that you can create for yourself. And think of the stage of life you're in right now, right? I asked every single one of you guys, like, how long are you willing to be in the stock market for? Every single one of you guys said you're in it for the long term. But long term looks different for certain people. Long term for some of you could look like 40 years. Long term for some of you looks like 20 years. Long term for some of you looks like 5 to 6 years. And so long term looks differently for every single person. And so I'm going to share the different types of portfolios that you can create, the different benefits of each portfolio, so that you can kind of assess, okay, maybe it would be good for me to create a portfolio kind of like this. And so the first one is called DGI. DGI. And it stands for dividend growth investing. And this is a type of portfolio that specializes in buying dividend stocks. But very important, it's very different. It's not just any type of dividend stocks. Let's see. Stephanie said, I can't see any slides. Can anyone else see the slides? Let me know in the chat if you can see slides. Okay, same here, weird. Okay. Let me see if I can fix that. All right, can you guys see the slides now?
It's just a black screen.
Still weird. Okay, I think Zoom is having some issues. Let me see. How about now? No?
It like briefly flashed and then it like went blank.
That is so weird. Okay. Let me try to open up just a completely new tab. Still black screen. So none of this is showing.
I think I can see your mouse pointer,
Uh-huh.
but it's just a black screen.
Okay, let's see. I wonder if you can see other screens. So let me see if you can see, like if I opened up, can you guys see this? It's my Webull technical analysis stuff. Nope. All right, let's see. Share. All right, so this is what I'll do then. Since that's not working, good thing I'm in a classroom. So we'll use the classroom. I'll draw my whiteboard. Hopefully you guys can see this. All right, can you see this? Is this good? All right, we'll do whiteboard sessions. All right, so the first type of investing is, it's called DGI. DGI stands for dividend growth investing. So in dividend growth investing, what you're specializing in is not just stocks that pay a dividend, more specifically is stocks that are increasing their dividend. So very, very different. There's certain stocks like AT&T, right, that they pay 7% dividend, but their compound annual growth rate is only like 1 to 2%. So they're only increasing their dividend by like 1 penny or something like that. Then there's other types of companies out there. A company that I used to own is called Broadcom. Broadcom is ticker symbol AVGO. And that company, they were growing their dividend at around 33%. And so, for example, if a company is paying $1 in dividend a year, if it's growing 33% annually, you buy into the company. It is the first year you get $1 in dividends. The next year you get $1.33 in dividends. The following year, you're now compounding, you're getting a lot more in your dividends. And so you're creating a portfolio because this is a long-term growth portfolio. Sometimes, and this is what Warren Buffett specializes in. And so the most successful investor in the world specializes in dividend growth investing. His investments back in the day, specifically in Coca-Cola and American Express, at the time he bought it and the dividend was maybe only 3%. But now on his original investment, he's now making 20, 30, 40, 50% on his original investment. So let's say back in the day, he put $10,000, right? Let's say back in the day, 20 years ago, you put $10,000 into an investment. And at the time, you're only getting 3% on that investment. But 20 years later, you're now getting 50% annually. So now you go from 3% of $10,000. So you're making like, I don't know, the math, maybe like $30 or something like that, versus now making like 50% in dividend income. You're making like $5,000 a year. So the best way I kind of describe it is think of it like rental properties, right? You buy a rental property, you buy a home, you rent it out to someone, and every single year you increase the cost of their rent. It's not that you're paying any more for the property, you're just increasing the rent price. And then so in the same way, dividend growth investing is a powerful strategy to be able to grow and compound your wealth over time. And so this is great for people who want to kind of build that retirement portfolio. So personally, I don't really use dividend growth investing that much. Because I am more focused on being someone who's younger. I'm focused on a higher growth portfolio because I have the years that I can allow my investments to grow. I'm going to want something more aggressive, and we'll talk about that in a second. But dividend growth investing, I still use this strategy. It's not my main strategy in my portfolio, but I do have some dividend growth companies, meaning these stocks are going to grow rapidly over the next few years, growing their dividend and their share price. And so how do you find a good dividend growth stock, right? How do you find a good dividend growth stock? You guys can use the website. I shared with you guys a couple of weeks ago. It's called Simply Safe. So Simply Safe Dividends is a website that you can use. And the annual subscription to this service is $400. But here's my secret strategy. They offer endless free trials. So they literally offer endless free trials. All you got to do is just type in a different email, type in a name, and then you can use their service. But in Simply Safe, what they do is one of my favorite tools. They do all the hard work and the heavy lifting for us, is that they tell you what is the rate of growth of the dividend. So it doesn't just tell you how much the dividend is, it tells you how fast and how quickly that dividend is growing. And you can categorize it as like, hey, what company is growing their dividend the fastest? The reason why Broadcom got put on my radar was actually through using Simply Safe. People weren't talking about it on the news articles. People weren't talking about it on YouTube. Like, no, it didn't get any coverage. But I was just looking for a company that was growing its dividend very rapidly. So this is a great resource to be able to find those types of companies. So with dividend growth investing, it's beneficial to have these in your portfolio, but there is a downside. So there is a downside with dividend growth investing. And that is this. When a company pays out its dividend, you and I have to pay tax on it. You and I have to pay tax, right? And that cuts into my profits. Personally, I like this strategy. I think it's great long-term to have dividend money coming in, but I like a company that keeps its profits and reinvests it into the company and grows the company. And then that is money that is not taxed because the company is just using their own profits and they're growing their company. And I make money not through a dividend, but I make money through the share price appreciation. And so that's why you look at certain companies. So like Chris had shared earlier that he bought Facebook stock. It's my largest position. I love Facebook for many reasons. And one of those reasons is because of their balance sheet and stuff like that. But you notice that companies like Facebook, like Netflix, like Google, none of those companies pay a dividend. Why? They don't pay a dividend because they realize that if we keep the dividend, if we keep our profits and reinvest it, our investors will actually make more money because we know how to manage that money well and better than these investors. And so that's personally why I don't have too much dividend growth investments within my portfolios, is because there is that downside. But the reason why this could be beneficial for many people is because people who are in kind of retirement age, they need that income. They need that income every single month, every single quarter, so that they can pay off their bills and stuff like that. And so there's stages of life where that is needed. And so the most successful investor, Warren Buffett, he created his kind of stock portfolio that people can buy into called Berkshire Hathaway. And if you notice, Berkshire Hathaway, it doesn't pay a dividend. Why? Because Warren Buffett understands that he can manage that money better than his investors can. And if he keeps that money, he can then reinvest that money into the business. So that's the downside to dividend investing. The other types of portfolio is growth. So the next type of portfolio is growth. Growth portfolios. Growth portfolios is personally my favorite, but there's many downsides to growth portfolios. Growth stocks are stocks that are very, very volatile, meaning that they can be up 20% in one day, 10% in one day. And then on the flip side, they can be down that much in one day. So I like growth because I have the time horizon for it. Growth it really caters towards people who have a 10-year time horizon that they can hold an investment. If they can hold it longer, even better. But growth is for people who can let and buy into companies that need years to kind of establish its infrastructure before it becomes extremely profitable and begins to make a lot of money. So for example, some popular growth companies that were growth companies, they're not growth companies anymore, but they were growth companies, Apple and Amazon, right? These are the companies that you have to give them 10 years for them to be able to see substantial amount of gains. Because back in the day, like everyone loves Apple now, but people forget Apple. There are certain periods in time where Apple lost investors 70%, 80% of their portfolios, because back in the day, they were higher growth. They were spending a lot of money, borrowing a lot of money to be able to grow their business. And so growth, typically, how do you define a growth stock? Well, a growth stock is a company that's growing at least double digits in their revenue, at least 10% and beyond. There's some growth companies that they're growing their revenues 20, 30, 40, 50%, right? You guys know two companies I own. First one, Tattooed Chef, they're growing 63% revenue growth year over year. That is a growth company. You don't see companies like Apple. You don't see companies that are smaller or not smaller, that are more established, growing at 63% a year. That doesn't happen anymore. These companies have already grown. XPeng, they're selling their vehicles and they're literally doing 500, 600% growth. And so these companies, the benefit to them is high risk, high reward, right? High risk, high reward. A helpful tool just to kind of let you know how volatile a stock is if you go into Yahoo Finance or if you go into any financial statements thing, you'll notice that there's something called the beta. The beta. It'll say beta underneath like the market cap and stuff like that. It'll kind of be around there. And beta, basically, what is beta? Beta measures the volatility of a stock. And this is just helpful for you to know, just for your mindset, to know as you buy into a stock, how volatile it is. Because there's certain stocks that they're just going to move maybe 1% a day, and that's a lot for them. There's other stocks that are going to move 5% a day, and that's normal for them. So beta, the median number for beta, it was based off of the number 1. So beta is 1. And this beta is the S&P 500. So that, remember, index, the S&P 500 is the compilation of the 500 largest companies out there in the publicly traded market. And the S&P 500, it doesn't move much, right? If you guys ever track the Dow Jones or the S&P, you realize it only goes up 1%. If it's crazy day, it goes up 2%, you know? Those are crazy moves for the S&P 500. So that's 1. So if it's a 1, that means it's trading around like the S&P 500. If it's trading at a beta of 2, a growth stock, you'll notice this in like Yahoo Finance and different things. Newer companies don't have betas released yet, so they don't. But if a company has a beta of 2, that literally means it's going to trade twice as volatile as the S&P 500, twice as volatile. So on a day where the S&P 500 is up 2%, this stock is going to be at 4%. They're going to be at 5%. And so have you guys noticed that in different companies, maybe on your watch list and stuff like that, you'll notice that there's certain stocks that they always fluctuate lots of percentage points day in, day out. That's typically because they are growth stocks with a high beta. So high beta. And that's just important. And this doesn't affect the fundamentals of a company at all. This doesn't affect the financials of a company. It's just, I like to know the beta so I know how volatile my stock is going to be. And perhaps it helps me get a good buying opportunity, right? On a higher volatile stock, I want to buy that stock when it takes a fat dip, because again, growth stocks, they dip very hard. And so growth stocks. So the benefit of a growth stock portfolio is that you could see substantial gains. I mean, everyone wants gains in their portfolio, right? Growth stocks have notoriously been known to do over hundreds of percents easily. You look at the big growth stocks of the last few years. Netflix was one of the biggest growth stocks of the decade. I mean, that stock went from like just pennies to where it is now to over $500 a stock. Facebook, when it IPO'd, it was at like $20. Now it's at $336. And that's within a matter of less than a decade. So high quality growth stocks are companies. Let me give you some examples of the companies that I own that are the higher quality growth stocks. Palantir is one of those companies right now. Financially, it's kind of a mess, right? It's not good financially yet. It's not profitable yet. The ratios are very, very high. And so growth stocks, again, there's a lot more risk to them. But if I see them like, okay, if this business is going to be good in 5 years from now, and this thing is going to grow to become a beast, you could reap substantial gains and rewards because you're buying into growth stocks. So some people do completely growth portfolios. growth. It's just they're increasing revenues dramatically. And there's not many companies that do that. So I just want to say that too. There's not many companies that can do that well and consistently. And so if you find a good growth stock, I would say do some research. It's worth doing research because there's not many companies that can grow revenues 30-40% year over year consistently. That's hard for companies to do. It takes a good, for me, that's a good indicator of potentially a good management team or a really good product and service. And so that's kind of just like, that gets my attention. I'm like, ooh, okay, this company is growing rapidly, consistently. It got my attention because they're doing something right. And I want to look at this company. So growth portfolios. The next type of portfolios that people create is income portfolios. So income portfolios. This is great for really everyone. This is more geared towards retirement people who are in retirement. They don't need to make substantial gains in their portfolios. These are the people who have $1 million in their 401ks, and they just need like 3 to 4% a year on their $1 million, and they're making 40K a year in dividends, and they can live off of that because their home is paid off, and all they got to do is, spend time with the grandchildren, buy toys for them, and so they don't have a lot of expenses. So income portfolios, what it's really used for is to preserve capital. So let me say that again. Income portfolios are used to preserve capital, not so much to accumulate a lot of money. Very rare situations where you can get an income stock generate substantial gains. It's very rare, but it's definitely possible sometimes. And so let me give you an example of an income stock that I've shared before, and I've shared this publicly. Is Realty Income, right? Realty Income is that real estate investment trust that they own the properties of Home Depot, Dollar General, AMC Theaters. They own the property, and these companies are in long-term leases with them, like 10 years, 15 years. And so they have to pay Realty Income every single month, and they pay that money back out to the shareholders. The price doesn't fluctuate very much. I was buying Realty Income, not really heavily for my portfolio. I just had a smaller position size within. I had like 100 shares, and I was buying it at within the 50s. And then I sold it actually in the 60s, in the later 60s. And so I collected income from it every single month. It was just a safe place to store my cash while I was looking for other investments. And so that was my strategy. Some people, and it's great, like I know people personally who bought Realty Income because they're like, oh, I saw your video, I bought Realty, and they just kept it. And now this stock's at like $70 or something like that. So they're up like 30% while making monthly dividends every single month. And so income stocks, really the benefit is to preserve capital. It's very rare that you can actually accumulate large gains with income stocks. But income stocks, think of the stocks that people buy, like Realty Income, AT&T. People like to buy these types of companies just because they give dividends consistently and they focus on the dividend. Share price doesn't fluctuate very much. Is there place for this in your portfolio, in everyone's portfolio? I think so. If you find a good and compelling deal, right? And the purpose of it is because I like income stocks is because it can build my cash reserves. Income stocks build my cash reserves. Whenever I'm investing in different growth stocks, my capital is dried up. They're not giving me any money back. Like the way I get more money to invest in stocks is I work a job, my wife works a job, and we make money that way. And so we use our earned income to plow back into investments. The nice thing about income stocks is it's building my cash reserves for me. And so that I use income stocks sometimes to keep my cash growing and to create a stockpile of cash I can invest more. So that's income stocks. You'll notice, so how do you know if a stock is an income stock? You'll notice that there's not much growth in the stock price, and a lot of people just buy it for the dividend, and their dividend doesn't grow. Like you'll notice that about income stocks is that their dividend grows maybe 1%, 2%, 5% maybe. So that's income portfolios. So, and then we'll look at blue chip portfolios. So whenever I was, a lot of people, when I was, and they asked to kind of be a part of this program, there's a lot of people who told me, that they're good with blue chip portfolios. People who didn't want to join the course because they didn't understand that the stock market is so much bigger than they could see. They just thought, oh, if I just buy blue chip, then I'm good, right? And that was a limiting mindset. That's a limiting belief that if you just buy blue chips, then you're going to perform well in your portfolio. Remember, blue chips are established companies. Blue chips are companies that are already established, already profitable. They're already big. They don't move much, but they're reliable. They're reliable, right? You know that they're able to weather through economic storms because they've done them before. You know how much money they're going to make next year because they're not making much more money every single year. Blue chip companies are known for just kind of maintaining profitability. These companies, I've shared with you guys, what I like to personally do in my portfolios with blue chips is that I sometimes do short-term swing trades. Meaning if it's really undervalued historically from a ratio standpoint, like a PE ratio or the other ratios and stuff like that, I'll buy a good amount of those shares. And then whenever it goes up like 10%, I'll just sell out. And when it returns to fair value. And so blue chips, personally, what I do is I use it as a place to store cash short-term, or some of the blue chips I actually hold. And so some blue chips I sell, but some blue chips I hold because I need more stability in my portfolio. My personal portfolio is a high growth portfolio right now. And so I need some stability in my portfolio. So blue chips offer me that stability just in the scenario. Let's say that there's another black swan event. Black swan just means that you didn't foresee it coming. COVID was a black swan, and the economy just goes horrible, right? And I lose tons of money in the stock market in the short term because of a black swan event. Well, blue chips, they don't move much. They don't move much during that time. And so I like to diversify my portfolio and have some blue chips in there just for in the situation that my portfolio gets decimated because of something like COVID happening. And again, it's only short-term losses. Long-term, I'm fine. But just to wear out the short-term things. So a strategy that I was doing, so here's why I wanted to share that. Why do I want to preserve capital during a bear market, right? Why do I want to preserve capital during a correction? Blue chips, they don't take that much of a beating, right? During COVID, everything did go down. Growth got destroyed. Blue chips got destroyed, but not as severely as growth stocks. And so what do? Well, for blue chips, during bear markets, sometimes I'll sell out of my blue chips. I'll take a loss sometimes or break even. And I will use my preserve capital to then buy up all the bargains. And so like, let's say, because I was making money on blue chips just for a few years, because they don't make much money. I had Johnson & Johnson. I held that company for a long time. And Johnson & Johnson only did like maybe 10% a year for me, but it's one of the safest companies out there. During COVID, I sold out of it for a small profit, reallocated those profits because that was a safe haven, right? And then I was buying up stocks during the COVID crash. And so sometimes I'll keep my money in blue chips in my portfolio. So during a downturn, I will liquidate my blue chips to then buy up all these different deals. So those are blue chips, my different strategies with blue chips. And then the last thing to consider with your portfolio construction, and then I'll wrap up with like, okay, how do you start building, knowing all these different things, is you need to figure out are you going to go long or are you going to go short with your investment? Are you going to go long or are you going to go short? You have to figure out in your mind, how long am I willing to hold this investment? How long should I hold this investment for, right? You need to know that very clearly in your head. There's certain investments that I need to hold longer term to see their business model play out, right? Whenever I share with you guys Unity Technologies, a company that it's not going to see profitability until 2023. It would be foolish for me to sell anytime before the year 2023. Why? Because they haven't actually had time to grow their infrastructure, scale their product yet. And so I know that I am in that company for at least 2 more years, at least. I'm not selling any of my shares. If I do, it's because like I'm going to sell some shares if it gets a little high so that I can hopefully scoop up more shares on a dip. And it's just something that I do just to try to make a little bit more profit. But overall, I'm going long on those companies. There's certain companies you need to know, are you going long or short? The companies that we go short on, remember whenever we did, I forgot which session is, but you have to categorize your stocks. You have to know what type of stocks you're owning. The companies I go short on is if I'm doing a short-term value play. If I'm buying a speculative stock that just spikes and grows like crazy, I'm not going to hold on to a speculative stock that I don't really believe in long-term. And you have to figure out if you're going long versus short. And this is why I share that. In your portfolio, you need to separate these two. When you guys have these things in your portfolio, you can forget, like if your stocks are all jumbled up, let's say, for example, like you got a Facebook and you have an Amazon, and then in between Facebook and Amazon, you have like a very speculative stock. And it's kind of just jumbled in there. And so during your portfolio management, you kind of just forget that that's there. You need to, what I personally do, some people have asked me, why do I have multiple investment accounts? It's because I separate the types of investments that I have. And so that's very important for my own sake to be able to manage my companies I invest in. So there's my blue chip portfolio, meaning these are companies I never look at, never. I don't have to keep up with it. There's other portfolios that I have that is my growth. That's where I hold my XPong. That's where I hold my Tattooed Chef. That's where I hold my Palantir. That's where I hold those types of positions. Why? Because I need to keep an eye on these things. I need to figure out what they're doing. Are they able to execute every single quarter? These are the types of companies I need to keep up with. And so you need to know which companies do you actually need to keep an eye on, right? Think of it like, I don't know. I think of it like almost like a parent. Like there's certain kids that parents have that like, you don't even need to watch them, right? They're good. They're well behaving. You know that they're going to do the right things. Then there's other kids that you're like, oh, where's Jimmy? You know, like I got to keep my eye on that kid. In the same way, that's how I kind of treat my growth stocks. They're kind of like that crazy, rambunctious kid that I need to keep an eye on them for their own good. And so for my own good as well. And so that's why I personally split up my investment accounts. I have many different accounts that are for their own things. So I have my dividend account, I have my growth investment account, and yeah, just have different like accounts. I have my retirement accounts, and those are very different in the types of companies that I buy. And so the reason why you have to figure out long versus short is just for your own management ability. So you can understand like your stocks don't get jumbled up. And for example, let's say, again, going back, there's a stock that you bought, you just in your portfolio is next to Facebook, and it's between Facebook and Amazon. Let's say you forgot to keep up with that stock. It's not executing on vision. They're not making as much money as they said they would. You kind of just forget it because it's in between two high quality companies. And so that's a very practical thing. So you need to know whether you're going long or short. All right. And so here's kind of where it comes together. Obviously, you and I have a huge benefit that we get to make our own decisions and that a fund manager is not making your investment decisions for you. And so here's the benefit. We get to pick the best from each category. I get to buy the best growth stocks. I get to buy the best income stocks. I get to buy the best blue chips. It's not like I'm buying an index where I have to buy all of these companies. I'm just looking, okay, what's the best growth right now? What's the best dividend growth stock right now? What's the best income? What's the best long-term, short-term play? And so for me, what I do is, and this is why I teach in this course, it's a combo. Like we learn everything so that you can become proficient in making money in every single type of stock, because there's money to make, there's money to be made in all of those types of stocks. And so, so when you guys begin thinking about constructing your portfolio, think about it as a combo, like literally like, it helps so much just to write these things down. Just write down like, okay, income stocks. What are some income stocks that I need to kind of just be aware of and keep an eye on? What are some growth stocks that I want on my watch list that I want to keep an eye on, that if there's a good buying opportunity that I'm going to strike on those things? And so a combo, think of it like you have your dividend growth investments, you have your growth stocks, you got your income stocks, And under each one, you have your watch list. So you're creating separate watch lists to be able to build out your portfolio. And so here's my biggest word of wisdom that I learned from a mentor. Don't force an investment. Don't like fall in love with a specific style. Don't fall in love with a specific style. I've seen this time and time again where people, they force themselves, they want to create a growth portfolio in an environment in the market where you should not be buying growth stocks. So for example, December, January, February, I would not touch growth stocks with a yardstick. Like they were way overvalued. I love growth stocks. I wanted more growth stocks, but I can't fall in love with a specific type of investment. Everyone was loving growth stocks at the time. They're saying this company is the next big thing. This company is the next big thing. This company is the next big thing. And when growth stocks were getting all the attention, over here, blue chip stocks that was where the deal was at. And so I was creating a blue chip portfolio. I was adding to my blue chip portfolio. Over the last 3 to 4 months, growth stocks took a beating. Everyone wanted quote unquote safe stocks, right? Safe stocks are the blue chips. And so people were running to blue chips. What was I doing? Well, now it's time for me to create a growth portfolio because that's where the opportunity was. And so strike where there is opportunity. Don't force an opportunity. Don't force yourself to fall in love with a specific style. Just look, where is the opportunity at? And so it would be helpful, you don't have to, but it would be helpful to have multiple different brokerage accounts with different brokerages, or maybe with different accounts within a brokerage, just so that you can have your own growth portfolios and et cetera, all that kind of stuff. So that's the combination. So the next thing that's very important. So how do you, okay, so now that you know this, is like, okay, you create a combo. Okay, the last thing I forgot to talk about is percentages, right? Like, okay, how much do you allocate, right? How much do you allocate to, like, let me add BC, that stands for blue chips. So how much do you allocate to blue chips, dividend growth, income? Well, it really depends on your risk tolerance and time horizon, right? Two things, your risk tolerance and time horizon. For me, I have a longer time horizon and a higher risk tolerance. So right now I have a very high growth portfolio, very high growth. I know that I can lose thousands and tens of thousands in a day, but I know I can make that much in a day. And that doesn't bother me. That doesn't faze me emotionally. And it doesn't deter me psychologically from making bad decisions. And so you have to understand, okay, what's your time horizon and what's your risk tolerance? And this is how you know your risk tolerance is if you feel bothered by how much money you can lose. Like, let's say your portfolio is down $3,000. If that bothers you, that's your risk tolerance. That's too much of your risk tolerance. And you're putting yourself in a situation of feeling way too emotional about your investments, and you can make a bad decision based off of your emotions. And here's how you also know your risk tolerance is, you're not in a good place for your risk tolerance. Let's say you make $3,000 in a day and you get really happy about it. For me, if I make $3,000 in a day, I'm not happy about it. I'm just like, cool, all right, let's move on. And it's just like, I'm not going to get super excited because I know that's my portfolio. It's going to do that day in, day out. And so you have to kind of understand, okay, where are you at? That would be like, you won't be emotional about it. So that you can just kind of let your investments grow, that you won't touch it, that you won't check up on it 50 times a day, you know, when you're in the bathroom, whenever you're in the kitchen, whenever you're like all over the place, checking up your investments. It's like, no, build a portfolio that you don't have to do that. Because at the end of the day, why do we invest? My philosophy I've shared with all of you guys, why do we invest? It's not so that we can go buy a Lamborghini or anything like that. It's so that we can make our money work for us, so that we can focus on what matters the most in our life. Our family, the people we care about, the people we love, the people we want to bless. Like, that's the goal. It's not for us to be sitting around checking our portfolios while we're with these people. It's so that we are detached from our investments, so that they work for us, so we can go do what we want. And so for your percentages, that's how you got to do it. If you have a higher risk tolerance like me, 40% of my portfolio can be growth. 40% of my portfolio can be growth. If it's a lower risk tolerance, maybe 20% growth. So you just have to kind of figure it out on your own. And so the next few things that I'll share that I have on my slides, we'll kind of talk about, okay, the next steps, right? So and establishing how do you build it brick by brick. And we'll talk about that in just a second. So these are the different categories. The next thing that we have to talk about is this is the money maker right here, your watch list. This is how you make money, right? This is a huge component. You have to have a good watch list, right? You have to have good stocks on your radar. Very important. If you don't have a good watch list, then you will never buy into good companies. You need to have not only a good watch list, but you can have a lot of companies on this watch list. Some people, their watch list is only like 2 to 3 stocks, maybe 5 to 10 stocks. And I'm like, that's not a good watch list, because you're going to constantly feel the pressure to buy into those companies. But if you have like a comprehensive watch list of really good companies, you're going to be able to choose like, okay, what's the best bargain right now? Like if there's any of them that gets beaten down over short-term problems and stuff like that, you will feel inclined to purchase that rather than have like a small watch list of just like 5 companies. And you're going to constantly feel the need to buy it, and then you buy it at a bad price. I've seen people do that over and over again where, for example, like they kick themselves and like, oh, I should have bought this stock. Like some so-and-so was telling me about it. And because they don't know any other stocks out there, they like try to force themselves to buy that one stock. I've seen this with people that I've talked to personally, as I've shared about XPeng. It's up almost 80% in the last few, like 2 months, right? 80%. Some of my friends reached out to me like, oh, dang it. Like I should have bought it whenever you're posting and stuff like that. And they're asking me, oh, should I buy it now? And I'm like, no, like you're going to buy this thing after it rallied 75%. It's because that's the only stock on their watch list. They don't know that the stock market is filled with thousands of stocks. And so if you have to have a comprehensive watch list. And so how do you build a watch list, right? How does this actually happen? How do you find good stocks on your radar? Well, the first one is personally, let me share with you how I build my watch list. So let me share with you how I build my watch list. First, I'll use a few different sources. I'll use Simply Safe Dividends, and I'll look at the financials of a company. I'll be like, okay, what companies are growing rapidly? What companies are increasing revenue? Like I use like different stock screeners that are just like, hey, tell me what companies are growing 50% revenue. I just want to see a list of those types of companies that are growing 50% revenue. And I'm just looking for companies in industries that are growing rapidly. And I just toss the top ones on my watch list. And so that's how I'll find some stocks. And these are stocks that I've never even heard about. These are stocks that I don't know anything about the business, right? I didn't know anything about XPeng. I didn't know anything about my newer position, Corsair Gaming. I didn't know anything about Advanced Micro Devices. I was just looking at, okay, like what are like good, fast growing companies. So that's one thing I do, is just looking at the financials, what companies are growing rapidly, increasing their dividends rapidly. Another thing that I do is I use the Yardeni research that I shared with you guys over the last few weeks, is that I use that and just see what's a beaten down industry, right? A beaten down industry right now is semiconductors. And so I looked up, okay, what are the best semiconductors in the industry? Well, it came up with a few: NVIDIA, Intel, AMD, Micron. There's a few companies that popped up on my radar. I did a quick analysis of like, okay, which one is valued the cheapest? Which one has the best PEG ratio, meaning they're earning the most money in relation to the growth percentage, like which one has the best PEG ratio. And AMD was up there. Micron's also up there. So I'm looking and I'm comparing these two. NVIDIA, I love it. They're actually the market leader in the industry, but they're trading 3 times as rich, 3 times from a valuation standpoint, 3 times more rich than Advanced Micro Devices. So that's how I create a watch list. I'll look at undervalued industries. I'll look at, just try to find it through Yardeni research. The things that I'll do is I'll literally I'll use YouTube or Google. And this is where I put the least amount of weight. So I'll just literally type in like, okay, what are people buying on YouTube? Like just what are these stock YouTubers buying? Sometimes I find good stocks from them. A lot of them is just hype. Remember, they make money off of us watching videos, right? And I would say maybe 10% of the time, like I'll find a good one. Like out of the bunch that I'll just look at, I'm like, okay, what's on your list? I'll be like, oh, dang, that was that was actually a good company. And so sometimes I just YouTube different, just what are the top searches, what's everyone watching right now. They'll give their list of different companies they're buying. And sometimes I look at them, I'm like, how did you ethically share that you would recommend buying that company? Because the valuation is so stupid high, you know, I'm like, just like, how did they do that? But sometimes I do find, for example, one of my investments, Dropbox, I found that through YouTube. People are just like, tons of different YouTubers were talking about Dropbox. I looked into the financials. I was like, oh, they're actually like, this is actually one that's kind of compelling. And I ran it through my financial analysis and stuff like that. So whether it's YouTube or different articles, again, I shared at the beginning of the course, Motley Fool, Zacks, they literally get paid for us reading these articles. So don't take too much weight on these things. And I'll just kind of read through kind of what they're recommending. I've never actually bought something recommended from Motley Fool or Zacks, but it's just, I'm expecting maybe one day I'll find something compelling. So those are different sources that I look from to create my watch list. I've shared before, just sphere of influence, just talk to people around me, my family, like to help me figure out companies that are publicly traded that maybe are kind of under the radar. My brothers are huge Funko Pop fans. They buy lots of their products. And so that's a product that was no one knew about it. You know, it wasn't on people's radars. And the stock actually did 80% in the last few months. And so because they released all of these special edition items that sold out like crazy, they increased their sales like crazy, and it would have been a short-term speculative play for me if I did that. But my point being, your sphere of influence, and that's the benefit of this investor group. And so I've been a part of other investor groups, very high ticket investor groups, where you have to pay 4-figure plus memberships into these groups, and they kind of just to other investors. And the benefit of this program is that that's the goal for this family, right? That as this continues to grow, as I begin to scale this, is that we would all just toss out different companies that we're looking at and getting different stocks on each other's radars. And so that's a huge benefit as well. So creating a good watch list, put more things on your watch list rather than less things. And not only put things on a watch list, put alerts. So it's one thing to have a watch list. It's another thing to have an alert to tell you, hey, AMD is now trading $79, right? You need to have alerts to know and to notify you that companies that you are potentially interested in, if they hit a price that you like, right? So you have to have alerts. You can do that through pretty much any brokerage, except I think the apps, for example, I think Robinhood, Webull, they don't do that, but I think that there's other sources that you can use that can set alerts. So create a good watch list, and when opportunity arises, strike on it. Right. And so the first component now, that after you understand the different types of portfolios that people have, you have a good watch list, the first step that you want to do is you want to establish your core stocks, establish your core positions, This is so important. Your core stocks are companies that are the highest quality, because you and I want to put our money where there is high quality, right? We want to put our money in the highest quality stocks possible. And so you have to establish these core stocks. For me, my core positions is Facebook and Amazon. Facebook and Amazon for me holds around 40. I'm actually going to mix potentially, if Amazon gets down to around 3,100, it's going to be around 50% of my overall portfolio. Over 6-figure portfolio, half of it is in Facebook and Amazon. Why? Because I love these companies so much. They are consistent money makers. I see their profitability for the next 5 to 10 years. And these are my core positions. And so I know that I'm always going to make money with this 50% of my portfolio. Like I literally, like there is not a doubt in my mind that I'm going to make money. None whatsoever. But the reason why core stocks can't be my entire portfolio is for diversification purposes, right? Let's say something horribly happens with Facebook or Amazon. I'm betting against that, right? I'm betting, I'm like, I don't think so. Obviously, I think that they're going to be overthrown in 40, 50 years. Every company gets overthrown, but I don't think anytime soon. And so I established my core positions so that I can have peace of mind, so that I know that I'm going to make money on this 40, 50% of my overall portfolio. And it keeps me stable. So here's why it's so important. So this is a rookie mistake. This is a huge rookie mistake that I see people do all the time. They make their core stocks other people's peripheral stocks, right? So I've shared my peripheral stocks. My peripheral stocks are Tattooed Chef, XPong, potentially AMD, Corsair Gaming. These are my peripheral stocks, Palantir. But other people, they're making it their core stocks. They're making it like the core part of their portfolio. And what happens when you do that and make it a core part of your portfolio is those companies are not high as quality as Amazon and Facebook. They're not. No matter how you cut it, they're not. And the benefit of having core stocks, right? Establishing core stocks is that I can put lots of money in these companies and I can sleep well at night. I can have $50,000, $60,000 in Amazon and I can make a lot of money doing it. So for example, I don't need huge growth if I'm putting large dollar amounts into stocks. So for example, right, let's say $50,000 in Facebook. If I only get a 10% increase every year, Facebook's going to do way more than that. But if it only increased 10%, then I make $5,000 if I'm willing to put a ton of money in. Versus if I have a small position, right? Let's say a position like my smaller positions, like let's say Teladoc. That's one of my very peripheral positions. That I have $3,000 in Teladoc. Very peripheral position. I need to literally get over 100% just to make $3,000 on Teladoc. Before Facebook, all I need is a 10% gain. I need a 10% gain to be able to make $5,000. So you can put lots of money into core positions and trust that these things are going to grow over time because so what you're betting on is I'm putting a high amount of money and I'm trading that for assurance of consistent growth, right? A high amount of money for assurance that I'm going to at least grow this maybe 12, 15, 20% a year. And I know that it's going to do that because it's top quality. And so what are some other companies that are core stocks? Like, how do you find core stocks? These are the cream of the crop. These are the companies that have no debt on their balance sheets, right? They have no debt. They own everything outright. That's Facebook. Another company that I love that I would make a core stock, if it ever provided an opportunity, is Google. Google is one of those companies that they own YouTube. They own all of these different things that are very profitable. And it doesn't cost much for them to run it. It doesn't. From a business standpoint, versus you look at Google versus a food industries, their profit margins are so low because they have to package everything, manufacture everything. Whereas Google, everything's on the internet, right? So core stocks are like the Facebooks, the Amazons, the Googles. These are the companies that are run by incredible management teams. They execute on their vision. They do what they say that they're going to do. They're still growing rapidly, right? Facebook, for example, they're growing other parts of their business. The reason why it's my favorite company, they're growing other parts of their business like Oculus. They bought out Oculus and all these other things. And those parts of the businesses are growing over 100% a year. This company's already established and still growing parts of his business 100% a year. That's so rare to find. That's better than my best growth stock, Tattooed Chef, 63%. That's Facebook, a behemoth of a company that's almost $1 trillion valuation, still doing insane growth. So you need to have core stocks. Let me give you some examples of core stocks of the past, right? Core stocks of the past were companies like Texas Instruments. Back in the day, Texas Instruments was one of those companies that was just so it was innovating. It did everything for aviation to calculators to everything. Everyone used Texas Instruments. It was a very phenomenal company during its day. Warren Buffett's core positions is Coca-Cola. That's one of his core positions that he made. And another core position that he made was American Express. And these are core positions, very high quality companies that he bought at good prices that he's just let ride it out. So core stocks, you need to first focus on building out your core stocks. I know it seems boring. I know it seems like, oh, you won't get as much gains on them. It's true. But if you put most of your money there, you only need a few percentage points to see significant amount of gains. So establish your core stocks, core positions. And then from there, step 2 is to add growth stocks, then is to add your income stocks, then to add your blue chip stocks, then you add your speculative stocks, right? I actually, in the slides, I had it step 3. I said, sprinkle in speculative stocks. Some people, so this is why this is very important. It's so simple, right? But they go backwards. Sometimes people make speculative stocks their core stocks, right? These are the people who are going 10, 20, $30,000 into AMC. They're making a speculative stock their core stocks. Can they make lots of money in the short term? Absolutely. Absolutely, right? But my goal is that the most statistically successful method for a majority of people to consistently gain over time is through this method. It's core stocks, then you add your growth, then you add all these other things. And so start thinking about your portfolios right now. Do you guys have core stocks? Like, are there companies in your portfolio core, or are your companies right now, are they all kind of just like tons of peripheral stocks, like tons of just random growth over here, random income stocks, random this? You need to have core positions. Very, very important. Very, very important. So when it comes to like my peripheral stocks, right? The peripheral stocks I've been adding, I typically don't give them more than 5% of my portfolio, like my overall investment net income, like, or net worth. I mean, I usually only put it at like 5%, 4 to 5%. Why? Because with growth stocks, well, it's a little more risky. They're not as tried and true as my core positions. And so I typically give them 4 to 5%. Speculative stocks, I keep it at around 2% and less. So 2% and less, I'll play with speculative stocks. There's some speculative stocks that I've made good money on. There's some speculative stocks that I got wrecked on. But I always want to add some speculative stocks because it's worth it, right? There's certain speculative stocks out there that you can actually make good money on. So sprinkle them in, sprinkle your speculative stocks into your portfolio. And the next thing that's important, so this is building out a portfolio, right? Next thing that you need to do is, let's see. Step 4. You want to be in diverse industries. So when you build out your portfolio, a big mistake that a lot of people do is, I'm just going to buy all tech, right? We talked about this. I'm just going to buy all tech companies, or I'm going to buy all, I don't know, I'm just going to buy Apple and Microsoft. Like, those are the only 2 companies. Oh yeah, that's another core stock that I would personally create a massive position in if I could, is Microsoft and Apple. The reason why I think Apple is so amazing is Apple is one of the few companies that can bring 21% of their revenue to net income. That's insane. 21% of Apple's revenue becomes net income. You try to find a company like that. Very, very rare. Microsoft, the reason why I really like Microsoft, very high profit margins, 68 to 70% profit margins. Very, very good. So those are other core stocks that are phenomenal. But diverse industries, you want to be diverse in the companies that you own. I like, for my own portfolios, I want to have all sorts of companies. I want to have tech. I want to have consumer staples. I want to have food industry. I want to have everything. You want to be diverse in your industries because it just keeps you from getting wrecked, right? If one industry gets destroyed, your entire portfolio gets destroyed. There's so many times where I've seen people concentrate their industries to 1 or 2 industries, and during a bear market, they get destroyed, they get hammered. They just it's so it's bloodshed for their portfolios. But then on the flip side as well, the benefit of people who concentrate their industries is during a bull market, they see crazy gains. But personally, I think it's very important, and all the successful investors say, is to have diverse industries. Be involved in the different types of industries out there. Remember, there's so many industries. I think I shared it like week 1 or week 2 or something like that, of just all the different types of industries. So there's 11 sectors of the stock market, but there's way more industries, way more industries. So you want to be in diverse industries when you build out your portfolio. The next thing that you want to do is buy in portions. You don't go all in. That's a dummy move, right? I've seen people do this. They go all in. They got $1,000 to invest or 2,000, 3,000, and they go all in when they're buying into a company. That's foolish. Remember, what you want to do is you buy in portions. When it comes to blue chip stocks, when it comes to more stable core stocks, I like to buy in portions of like 50%, 25%, 25%, just because core stocks, they don't dip that much. These are the big companies that they don't move much. And so I don't want to miss the boat on these companies if I need to add to them. So if I have $10,000, I'm doing $5,000, 2,500, 2,500. If it's a growth stock, I'm buying in many portions, many different portions. I'm not buying it one time. I'm going like 15%, 15%, 20%, 25%, 30%. Like I'm buying in many, many different chunks because remember, growth stocks have high beta, and beta means lots of volatility. And so I want to be able to catch the stock all the way like down the dip and then back up on that thing. So I'm buying in many different chunks. When it comes to income stocks, when it comes to kind of all those stocks, I typically go heavier and then like I'll buy it in like 3 chunks. Sometimes I'll do a 50, 25, 25. Other times I'll do a 40, 30, 30. So I'll do a 40, 30, 30. Different investors do different types of strategies, but I've done that for the last 4 or 5 years and it's done pretty well for me. So the only one that's really different is the growth stocks. I buy in like 10 portions, like I'll buy so many times, but they're smaller chunks. So buy in portions, buy in portions. And then the next thing is how many stocks should I have, right? That's the big question. So after you start building core positions, right, you're adding all these, you're sprinkling spec stocks in. Like the big question is like, okay, how many stocks, right? How many stocks should I have? The answer to this honestly is subjective, right? But there are like benefits. There are certain numbers that can actually benefit more than others. And so at the end of the day, it is subjective, but I would say at first it depends how many stocks can you keep up with, right? Like how many can you actually keep up with? I see some people, they have 40, 50 positions in their stock portfolios. I'm like, are you keeping up with all those stocks? Like, do you know what's happening with those companies? It's very difficult to like have a good deep level understanding on a large amount of stocks. And so for me, I think my portfolio, I'm at like 20 stocks, like 20 different companies that I own, somewhere around there. But like half my money is in Amazon and Facebook, right? Half my money is there. And then so I'm not even looking at Facebook and Amazon. I don't have to keep up with those types of companies, but I am keeping up with my other newer positions. And so for me personally, like then I have like some blue chips, I have some income stocks. But really like I'm only keeping an eye on maybe 10, like maybe 10 companies that I'm really keeping an eye on. And after I've done all my fundamental and financial analysis, it's easy to maintain 10. So it's easy to maintain 10 because what does that look like, right? What does portfolio management look like, right? How do I actually manage different companies? So let me erase this now. So companies that I've shared with you guys. Right, these are like some of my growth positions like Tattooed Chef, XPong, Palantir, Unity Technologies. Really, it only takes me to manage this and like all my other positions 30 minutes a week. That's it. Like the most. This is what I do. I go into Google once a week. I type in Tattooed Chef news. I type in XPong news. I type in Palantir news. And I type in Unity Technology news. And so Google gives you like that news section. It tells you what the company's doing. And so like there's certain times whenever I post on like my Instagram and stuff like that, it's like, oh, Tattooed Chef, hey, they're releasing new products. Or Xpong. For Xpong, I check every month. I don't even check every week for Xpong. I just want to know how many cars are they selling every single month, because they release that number every single month. And so I just want to know, okay, how many cars did you sell? And was that an increase from last month? And was that an increase from last year? And so that's how I look at Xpong. Okay, they're on track. They're growing their numbers at the set number that I would like them to grow at. Palantir, they make their money doing contracts, right? They make contracts with certain with the US government and with certain companies to manage their like their data and stuff like that. So I look at Palantir, okay, how many contracts are they doing? They just did one with the CDC recently. So I just keep up with, okay, what types of contracts are they doing? Same with Unity. They have a software that they give to designers. And so they create 2D and 3D things. Oh, who's using Unity technologies? For example, oh my gosh, Coachella just used Unity technology for something. Oh my gosh, Audi and BMW just made a partnership with Unity technology. So I just kind of keep up with them. So that's what I do with my growth stocks. And then I keep up with the 10Qs and the 10Ks. I just want to make sure that management is executing and the earnings call. So I listen to those things. And again, it takes me like I say 30 minutes a week during earnings season, right? Companies report earnings at different times. An earnings call, I'll read through it. Maybe it takes me like 20 minutes. Doesn't take me too long. So I'll read through my company's, the transcripts of their earnings calls. Just kind of know what's going on. And so that's how I figured out different things with Xpong and Tattooed Chef that gave me over 50% returns because I was listening to the earnings calls. So that's what it looks like when it comes to just maintaining and how many stocks should you have. If that's too much for you, right? If that's too much, if you're like, like doing 10 companies is too much, then have your core positions and maybe just have like 3-4 growth stocks and then have the rest blue chips, right? And so it really just depends on your ability to keep up with your portfolio. So that's part of portfolio management. So what is management now? So after you've built out your portfolio, you have all these core positions, you've now sprinkled in all the other things. What do you do now? Chill. Seriously, just chill. That's the investor game. A lot of the work comes up front. We do the research, we do study. Think of it like you're a business partner. We're business people, right? Investors are business people. You make an investment decision, you shake hands, you sign some papers, and then it's not like you have to go, let's say like you're buying into a coffee shop, right? Let's say you wanted to own a local coffee shop. You're not going to walk into this coffee shop every day and be like, all right, how's it doing? How's it doing? You know, you're going to be like, maybe I'll check up on it when I want coffee, you know, that doesn't really matter to you. And so treat stocks the same way. It's just chill. Like once your portfolio has been constructed, management just like spend time doing the things that you love doing. Now your money is working for you. Keep up maybe with the news once a week. 30 minutes is like max. During earnings season, it might be around 30 minutes. But just chill. Let the good ones grow is what I say. Let the good ones grow. If your stocks are doing well, they're executing, let them grow. Last session was if stocks violate certain things, these are my indicators to sell. And so you guys have a list of what that looks like. But if the company is doing everything it should, I let them grow. The next thing is for portfolio management. This is very important. It's your dry powder. Dry powder. This is your money on the sidelines. How much cash do you have on the sidelines to be able to continue to make investments? There's 2 types of dry powder you should have. You should have bulk dry powder. You should have bulk dry powder and consistent dry powder. Bulk dry powder means you should have money on the sidelines if there's a screaming deal next week so that you can jump on it. Remember during all of our conversations when we talked on Zoom, I asked you guys, how much money do you have saved on the sidelines right now? That if there was a deal next week that you could jump on it. You want to always have ammunition. You want to have bulk. So if you don't have this, for me, I typically like to say 10 to 20% in cash bulk. That's my bulk buy. So your entire net worth, I typically say around 10 to 20% that I have in cash. 10% is if it's during a bear market. I spend more money in the market during a bear market. If it's like during a bull market, I'm not really buying anything. So I'm building up my bulk position. So you want to have dry powder, your bulk, but then you also want to have consistent, right? You want to have this is your earned income. You need to be like working a job or something like that to have money coming in consistently. And so what is this? How does this apply to your portfolio? How does this apply to your portfolio? Well, I like to have my money on the sidelines, but I also like to be consistently buying. I'm not buying heavy. I'm buying just consistently. So my newest positions, I wish I could, because I had this on my screen, I wish I could show this to you of all my buy orders for Tattoo Chef. Like I wish I could show you that right now, but basically at the top, it was like, I bought 50 shares. When it dipped down, I bought 100 shares. When it dipped more, like I was just buying more, I was buying heavier and heavier. But then there was a time period, there's like literally like a month where like every few days, every week or so, I bought 5 shares. I bought 5 shares. I bought 5 shares. But on a dip, that's when I pulled out my bulk. I pulled out my bulk dry powder and I went heavy on the position. So I like to consistently be buying a little bit, just a little bit, like nibbles here and there, because, well, you still want your money working for you. And if the bull market keeps going, right? If a bull market keeps going, at least you're still making some of your money. So this is why it's very important. Dry powder, you need to have your ammunition on the sidelines. This is the bulk, but you want to have that consistent, you're buying into companies that you believe in, just very small, you're just nibbling. Do not buy a lot, just nibble, nibble, nibble. And if a screaming deal comes, pull out the big guns. So that's when you pull out the bulk. So that's what portfolio management looks like when it comes to your money flow. The next thing that we should talk about with portfolio management called rebalancing. Rebalancing. Rebalancing a portfolio simply means now you're buying certain stocks or selling your stocks because something is not balanced. There's something that's just causing your portfolio to be a little weird. So what are those things that make your portfolio a little weird? Let's say that you bought a company and it's doing phenomenal, right? And let's say it was in the clothing. Let's say it was in the clothing industry. You bought this stock, or let's use airlines because some of you guys bought airlines, right? Last year, you guys bought airlines and you guys are seeing 80% plus returns, right? We see phenomenal returns from the airlines last year. And now if you look at your portfolio, it's supposed to be diverse across all these different industries, right? Let's say you bought like some tech, but then airlines grew like crazy, right? Because you played the cyclical play. You understood this is a rebound cyclical play. Now it's going crazy more. And you have way more money in the airlines industry than you do a different industry. It's kind of just this unbalanced thing. And so rebalancing, I'll tell you what the professionals do. And when I say professionals, I'm talking about fund managers and stuff like that, and indexes. For example, the Russell Index, they rebalance once a year in June. They rebalance once a year in June. Some people, like Cathie Woods, very famous investor, she rebalances like every day. It's a little extreme for me. That's the whole ARK Invest. They have many different ETFs. They rebalance about every day. They're buying a little bit, selling a little bit. They've done phenomenal over the last 5 years. They're the best performing ETFs, hands down. No one's gotten close to them. But you and I have the ability to actually do better than those types of people because they have all these different requirements for running a mutual fund or running an ETF, whereas you and I, we can manage our own money. So rebalancing. Different people have different opinions, different takes on when you should rebalance. In my personal opinion, like every single day, that's a little extreme. That's crazy. You're not letting your stocks grow and manifest what they want to do. So for me, what I've noticed is around like 5 to 6 months is kind of a good rebalancing time. Like I was kind of just reassess my positions, like how much things grew. I look at it if like 4 to 6 months, I would say, just kind of depending how like the market is. What does rebalancing look like? For example, I've done rebalancing myself. Like I shared this with you guys last week, is that I trimmed some of my XPong position. right? It exploded. I was buying in the 20s and low 30s. It exploded. My overall position, I'm up 50% or so, and it was getting a little big. And remember, this was one of my more speculative stocks. This isn't a core position for me. This isn't a company that I'm like, ooh, I want to put tons of money in it. And so what I did was I was like, this is, when I looked at my overall, like for my growth portfolio, I was like, man, this position is like, it's getting more than 5%. And so I want to trim it down to get down to that 5% again. And so what I did is I took those profits and I kept it in my pocket, right? I just put it in my pocket. Few days later, right? That was last Monday. Few days later, I put that money that I took from XPong and I bought Corsair Gaming because I was like, okay, I want to rebalance. I want to put this somewhere. I want to put this to work. And Corsair was a company that I was looking at. I was like, okay, this is a good valuation. I happen to just get really lucky. This isn't normal. I just happened to get really lucky that today it went up 25%. I sold it at 22% portion of it. But here's my point. Rebalancing is when your portfolio just gets way too overweighted in a specific area. So there's different ways to offset that. You can either offset it by what I do sometimes is I'll sell, or you can offset that by actually buying more within a different industry. Depends on what you want, right? It depends how much dry powder you have. It depends how big your portfolio is and how big you want to scale it to be. But there's different methods. You can buy more within a different industry and let that like big position continue to grow and ride out. Or you can sell off some of those profits and reallocate it to a different industry. So rebalancing. Yeah, typically that's what causes portfolios to become just a little lopsided in certain industries if you see a massive amount of growth. Or if you see, let's say what are other situations where rebalance would be needed? Let's say a specific industry that you're investing in just takes a huge beating. It tanks, right? Let's say an entire industry sells off specifically. That could be a good indicator. Is like, man, my portfolio is kind of like this in this industry because it's sold off. I've lost money here. But it could be an indicator because you've already done your homework, right? This is now portfolio management. You've done your homework. You're like, this is a phenomenal company. So I'm going to buy more, right? I'm going to buy more into this industry because this industry is tanking in my portfolio so that when it rebounds, I'm going to get good gains on that. And then maybe you can trim some of your profits. But that's just portfolio rebalancing. It's very important because whenever people get too heavy on their portfolios, you're just imposing yourself to more risk. And that's not something that I personally like. And not necessarily risk of necessarily losing money, but you can be leaving profits on the table. Because sometimes whenever stocks go up really, really fast, stocks don't always go up, but whenever they're going up, it kind of feels like that. But that's why I like to take some profits off the table. I don't want to get greedy. I'm going to be like, hey, I made good money on this. I'm going to take some of my profits. Even though I could wish I could just keep letting it ride, I'm going to take some of my profits. So rebalancing. Okay. The next thing that we have to talk about portfolio management is two different environments. So there's two different environments within the stock market. There's bull and bear markets. Remember, session one, the average bear market only lasts 18 months. 18 months that your portfolio is going to bleed. And then there's bull markets. The average bull market over the last few years, I mean, we've seen some crazy bull markets, years of bull markets where stocks just go up, up, and up, that the year over year of the S&P 500 is just green every single year. So these are the different environments. So how do you manage a portfolio during bull and bear markets? So I'll tell you what it looks like for me. I've only gone through a few bear markets. I wasn't investing in 08, but I did see some of the other short-term bear markets. And so we're actually in a bear market right now in some of the high growth stocks, right? We've seen the growth stocks dip 30, 40, 50, 60%. And it's been like that since February. And so February to now, it's been a few months that we've kind of been in this bear market, but some of these stocks are now recovering. It's a quick recovery. But what do you do, right? What do you do? Let's talk about bear markets first, because bear markets, everyone hates them, emotionally speaking, right? You're seeing your portfolio bleed. I want to reassure you, and I'll tell you a million times, that during a bear market, that is where fortunes are made. You're going to lose money every single day in a bear market. You're going to lose money every single day. You're going to buy stocks every single day, day in, day out. and your portfolio is going to bleed and bleed and bleed. And you're going to question yourself, am I doing the right thing? It's going to get to you psychologically. But if you've done your homework, fundamental financial research, all of it, bear markets, what do? What's your portfolio management? Well, your dry powder, you should be using a lot of your dry powder. You should be using most of your dry powder. That consistent money, it should always be like buying stock. You should be focusing on buying heavy during a bear market. And I want to encourage you guys, like when you guys are bleeding, you've done your fundamental financial analysis and everything looks good, but the numbers aren't right. Just be patient, right? This is a long-term game. Just be patient. XPong, I was down 25% on XPong, right? I was down 25%. Now I'm up 50%. So with companies, if you do the research, like stay true to what you've done, you know that you did your homework, and you have to be aware that, hey, in a bear market, your portfolio is going to bleed. Do not sell out of stocks. There's a famous investor who says you should have the sell button should be broken. I always remember that. He says your sell button in your portfolios, it should be broken. Like you should not be able to click it. Like that is not an option at all. You can't eject and get out. So that button is broken. You guys know that I'm a follower of Jesus, and when my wife and I got married, it's similar to like they say divorce, never an option. That's not even a word that you put on the table. That is not an option. In the same way, during a bear market, selling, not an option. Don't even think about it. Don't think about it. During a bull market, what are you doing during a bull market? I'm not buying as much. During bull markets, I don't buy that much. And let me be a little bit more complex now. So within the stock market, because there's so many different industries, certain industries can be having a bull market while other industries are having a bear market. Certain industries can have a bull market while others are having a bear market. And this is why I taught you guys the different industries and sectors of the stock market. It sets you apart as an investor because you know that the stock market is complex. It's not just, oh, one big thing. It's many different components. And so what I'm constantly doing personally is like, okay, well, all the blue chips right now are in the blue market. I'm not touching blue chips right now. Bear market, well, growth stocks not in a bear market really anymore. They're recovering. So for me personally, like right now, on June 14th, 2021, what am I doing? I'm looking at everything. I'm like, dang, everything's in a bull market and growth is recovering. And so we're seeing a bull market and growth. Where's the bear market? I'm trying to identify where is the bear market? What types of stocks are being beaten down right now? For me, it looks like semiconductors, sort of, right? Like I'm looking at Yardeni research. What is being beaten down? Looks like semiconductors. It hasn't been beaten down crazy amounts, but it's being beaten down. So bull and bear markets. The other type of environments, and this was a question that came through, and it's a very important thing to know, is interest rates. Right, interest rates. If you're not familiar with interest rates, it's really just the percentage that you have to pay on borrowed money. Right, percentage that you have to pay on borrowed money. Companies have to do the same thing. So whether it's a mortgage, whether it's a car payment, it's student loans, right? It's the amount of money that you have to pay to borrow money. Right now, we are in a historically low interest rate, right? You can get a mortgage on a home at a 2.8% right now. A couple of years ago, you're looking at 5%, 6%. So right now, interest rates are very, very low. And so one of the questions that came in, it is, let's see. Oh, actually, I read this wrong, but I'll address this in a second. Their question actually, what types of stocks or category of stocks are you looking at that will perform well as we face inflation? So I'll address that in a second, but let me talk about interest rates right now. Inflation is a little different than interest rates. So interest rates, the companies that I like to buy during low interest rate periods like now is growth. Companies that need to borrow money to grow their business. Why? Because they can borrow money for cheap. The companies that I do not want during a higher interest rate environment, and this can seem a little complex, but it's really just simple. Like you just type in Google, what are the current interest rates right now? Interest rate charts. And you can just kind of see, okay, where are interest rates right now? during a higher interest rate environment. I am not touching any type of company that leverages lots of debt to grow its business. That means newer companies, generally speaking, right? Newer companies have to borrow a lot of money to grow their business. I'm not touching companies that are just way too much in debt or borrowing money because they have to pay buku bucks if it's high interest rates, right? If it's just medium interest rates, I'm not too worried. But if we're going to see a high interest rate environment, which we could see, tomorrow, I think that the government is having a formal meeting for 2 days or something like that to discuss interest rates. And so that's something I'm going to be keeping up with. It's tomorrow and Thursday. They're having a 2-day meeting, the federal people. So yeah, that's just something I want to keep my eye on, like where are the interest rates going, because that will set me ahead as an investor going into it. And so that's the first thing, interest rates. I like to buy companies with low debt during high interest rates. When it's low interest rate environments, I like to buy companies that have that need to borrow money to scale their business. All right, so let me address this one question real quick and we'll get back into the other stuff. So what types of stocks or categories of stocks are you looking at that will perform well as we face inflation? So as we face inflation, the prices of goods are going up, right? I think the last thing I saw, like corn up like 5-6%, gas going up very high. What I personally like is I want to see a company that is vertically integrated. So this is the key, right? This is the golden ticket right here, that in an inflation environment, I like to buy companies that are vertically integrated. This is a recap. What is vertical integration? A company is its own manufacturer, their own or supplier, their own manufacturer, their own distributor. They have everything from like creating their product to then selling their product. So like Apple, for example, they're becoming more vertically integrated because they're not buying chips from Intel anymore. They're like, we're going to create our own chip called the M1. And so why do I want a vertically integrated company? Tattooed Chef, vertically integrated company. They make their own corn. They're not buying corn from somewhere else. They're farming their own corn in California and Italy. Why? When a company owns their own farms, or when they own their own suppliers, they don't have to pay high profit margins to get product, right? They don't have to, like Apple's not gonna have to pay a lot of money to create to buy the M1 chip because they're making it themselves. Tattooed Chef, they're not gonna have to increase the price of their product so much so that their profit margins get decimated because they're their own suppliers. So that's one thing I'm looking at from a business person. Like as a business person, what type of companies? High inflation rates. Another thing that I mentioned in our Facebook group, in a high inflation rate, what happens is consumer spending goes down, right? When prices of everyday living, things go up, people aren't going to want to go and spend things like going to Disneyland. They're not going to buy the Louis Vuitton bag. They're not going to do those types of things because things are getting more expensive. They are more prone to save money than spend it. And so what I like to do, and this is part of the fundamental analysis, is I want to look for a sticky business model. So not only do I look for vertically integrated companies, I look for sticky business models. A sticky business model is just a product or service that you have to have based off of your own perspective, regardless of how much you have to pay for it. For example, an iPhone. Everyone's gonna, like, if you're an iPhone user, very unlikely you're just like, okay, I'm going to go get the Nokia, whatever. I'm going to go get the Samsung this, or I'm going to, like, very, very unlikely. You're going to stick to the iPhone. Or if it's like, for example, company like Netflix, they have very high retention. Just because like things are getting more expensive, like food and gas, you're not going to be like, okay, I'm going to go cancel my Netflix subscription. You want to buy a company that has a high retention rate. And remember, fundamental analysis, you want something that has a low churn rate, meaning the business is sticky. People are going to continue to buy it no matter the price. And so that's why I shared actually in the Facebook group that I'm looking at companies like AMD, because semiconductors, everyone needs it. It's not like that changes. Corsair Gaming, that's more like keyboards, mouses and stuff like that, like video game, like they're gonna need to buy a keyboard, they're gonna need to buy a mouse and stuff like that. It's not like they're gonna be like, all right, I'm gonna be done gaming because the price of corn and rice are going up. Like I'm just done playing video games. Like that's still gonna happen. So I move away from consumer discretionary. I don't touch consumer discretionary in an inflated market. Remember, consumer discretionary is things like travel, leisure, and luxury, right? I don't touch those things. Why? Inflation, people are not spending as much money. So that's for the inflation environment. All right, so the last thing I'll close out with is just some free, just random tips and tricks, right? Random tips and tricks that are just to give you guys value to be successful investors. And so the first just free value that I've found out over the years is that Morningstar Research, right? Morningstar Research, it's a service that costs $30 a month. But if you go to your local library, get a library card, this only applies if you're in the United States, and you get a library card, every single library pays for Morningstar Research. It's just like literally crazy. So, and you don't have to be at the library to do it. So you don't, it's not like you have to like, oh, sit at the library. You get to go through on your laptop, the library portal for Morningstar Research, type in the branch that you're in, which library that you're at, and then you type in your library number and you get a free research analysis company that does a lot of the heavy lifting. Remember, don't get lazy and be like, oh, I'm just going to rely 100% on this. They're just okay. It's not meant to like, they're not meant to substitute everything that we learned. Everything that we've learned, it's the most successful investors, the way that they do things. And that's been proven to be the most successful. Morningstar Research, they are great supplements, right? What do I use Morningstar Research for personally? I use it just, they have articles, news articles. I just read up on them. They're like, hey, this stock could potentially be undervalued. It could get things on my radar. They do ratios on it. They do the hard math for me. And so they do the ratios on it. They're good for blue chip stocks, value stocks, but they're horrible at growth stocks. For example, I remember back in the day when they said Tesla is only worth like $100 and it went on to be worth $4,000. So they're very bad. They're kind of like the older people who they don't know how to analyze a growth company. So, but Morningstar Research is $30 service, but you can literally get it for free, going to the library, getting a library card and using that. Another one is, again, the Simply Safe Dividends. It's a $400 a year service, but you guys can use endless trials. And so that in and of itself are two great resources that are available for free. Some other random tips and tricks that I personally do is I leverage credit cards to invest for free. I leverage credit cards to invest for free. If you guys don't currently have a credit card, maybe because you're like, I've been burned by a credit card, or you know people have been burned by a credit card, I always say this, just because maybe you've been burned by it, it doesn't mean that it's inherently bad. Just like a knife, just like if you cut yourself in the kitchen on accident, it doesn't mean the tool is bad. It just means that you used it bad, right? It just means that you used it bad. And so in the same way, there's credit cards out there that give you cash back rewards for simply using the credit card. So let's say you spend $100 on your credit card, you pay it off, always pay off your credit card, right? Always pay it off. You use it as leverage. They give you $2 back just because you use a credit card. That's it, $2 back. Obviously $100 is a little bit, but let's say your annual spending is like, I don't know, X amount of dollars. It can actually add up to a significant amount of money that you're getting cash back on. There's certain different credit cards. Some give you like 3% back on grocery. I have a credit card that gives me 5% back on gas. So every time I spend money on gas, I'm getting money back on gas that I have to buy anyways. And I take that money and I invest it. And it's literally fun for me to see free money being invested, and I see free money growing. And so not only do the rewards and points are a great tool that I use to leverage free money to invest for free, they also have great sign-up bonuses. So just my wife and I this past week, we just signed up personally for the Chase Sapphire Preferred card. Chase Sapphire Preferred card, they're giving 100,000 bonus points if you get approved. You have to have a high credit score to be able to get it, but that's $1,000 in cash back, literally $1,000. And the crazy thing about that credit card is it has an annual fee of $95, but I can downgrade it for free. I can downgrade it for free and not have to pay that annual fee. And so now I'm getting $1,000 for free from this card. and I'm taking that $1,000 to go invest it. I actually applied for another credit card 2 weeks ago and I got it. And I do this all the time. I just apply for different credit cards, take the bonuses, and I dump the card. I don't need it anymore. Another one is a Chase Freedom Flex. I get $200 for spending $500 on it. $200 for spending $500 in credit. I liquidate those points, take the $200 and I invest it. That's literally now you're investing with free money and you're growing your portfolio with free money. So I leverage credit card rewards and points to invest for free. Some other random tools that I use. I wish I could show you because I have the graph, but can't show you. But for me, just to get ahead of the curve, if I'm curious if there's going to be a stock market or economic crash or collapse, one of the most tried and true methods, and I think it's so simple, but it's literally gold, is I check how FedEx and UPS is doing. I check how FedEx and UPS is doing. If FedEx and UPS are doing well, their revenues are growing quarter over quarter, and they're like distributing all their like people's products all over the place, that is a sign of a booming economy. But in 2008, FedEx and UPS actually for the first quarter, they started to see a decline, a pretty significant decline over their quarters of just revenue being brought in. And if people tracked FedEx and UPS before 2008, they would have been able to avoid the economic collapse. Obviously, it's not to say that, oh, you should liquidate and sell out of all your positions. But what I would do in that situation, if I saw a sharp decline in FedEx and UPS and saw that the overall economy, and I use those other tools like consumer spending, and I saw all that going down, I would start securing my profits, right? I would start securing my profits, taking some of the money off the table, getting more cash heavy so that I can buy when the crash comes. And so that's something that I've used personally, analyzing FedEx and UPS for economic health. I actually did that in February and in January, whenever I saw a lot of things overvalued and just kind of things were getting crazy. And I just said, I'm not buying anything right now. And some of my friends were like, dude, how did you know that like growth stocks were going to crash? And I was like, I didn't. I just saw that there was a stagnation in FedEx and UPS. It wasn't that it was growing. I saw it stagnate. And I was just like, growth isn't growing like it should. So that avoided me from buying into growth stocks. I also avoided it because of valuations, but that just gives me another tool. So I analyze FedEx and UPS for economic health. I'm going to make a fun video sometime because I'm going to be done teaching at my school this week. But I'll give you guys another cool trick. It's called selling a cash covered put. Basically, selling a cash covered put is if I want to buy 100 shares of a company, I can collect free money for being willing to buy 100 shares. So if I want to buy 100 shares of like Dropbox, it's typically, I don't buy anything higher than like $20, $25, because that's buy 100 of them. So that's 2,000 something dollars. But if I sell a cash covered put, it's a strategy that not many people use, but it's a phenomenal strategy that I literally get free money. Sometimes I get $100, sometimes I get $200, just for being willing to buy 100 shares of something. So that's a strategy that people don't do. So that's something I'm going to create a video sometime this week and show you guys selling a cash covered put. But let me address some of these other questions that we have that came through the Q&R. So these are very important. First one, where can I look in order to find the TAM for a specific service? So where am I going to look to find the total addressable market, right? Very important in fundamental analysis is to understand what is the space that your company is in and how big is it, total addressable market. I use a few different things. The first one is I listen to the earnings call. The earnings call is where other high-level investors, they're asking management team these questions. For example, Tattooed Chef, in their last earnings call, they bought a tortilla factory. Who on earth knows the TAM for a tortilla factory? That's not common knowledge, right? That's not like, oh yeah, I know that the tortilla factory industry in the United States, they do this much every year. And so investors on the earnings call, they asked that question, what is the total addressable market for tortillas? And then they gave the answer. And so that's the first place I look. It's the earnings call. The second place that I look, and they have most things, they have most industries, it's called Grand View Research. Grand View Research is a phenomenal free resource out there. that you can literally type in any type of industry. So the reason why I know that Teladoc is going to have a huge total addressable market is Grandview Research. They run the numbers for me. They do all the heavy lifting. And so I don't have to like try to calculate like, oh my goodness, like oh, back in the day, people had to do that. But now there's research firms that do it for us. So Grandview Research is where I look for the TAM of a specific industry. Another question is, do you ever trade during the before and after hours? No, I never trade during before and after hours. I always say the only time that I'm willing to step into the stock market and make an action is if there's a price that I like. That's it. Like if there's something that's attractive, whether that's early in the morning, whether that's late in the day, it's not like there's some goons out there who are like, oh, just wait to the end of the day. That's the best time to buy. Or Friday, buy on Friday, because that's when the market sells off on Friday. That's foolish. That's so subjective. Like I'm literally like that. That's not a thing. So I just buy if I like the price. So regardless of time, regardless of day. Let's see. The last question that came through was, you mentioned that you set your portfolio and then rarely look at it. Do you set stop loss sales for your stocks in order to have a sort of guard against losing too much? So if you're not familiar with the stop loss is this. So let's say a stock is trading, like this is the stock chart, right? It's going up. You can set a stop loss at like, let's say right here. So let's say this stock is at $100 down here. It's $100, it's up $200. And let's say that's 150. A stop loss is if the stock corrects itself, if it hits 150, my brokerage automatically sells my stock. That's a stop loss. I personally do not use stop losses at all. Why? Sometimes the market's irrational. I can know that a certain stock is like, this is a good valuation, right? Like for example, like for me, Amazon, I know that from a valuation standpoint, it shouldn't be trading less than $3,000 because historically it doesn't trade less than a PE of 50. Like for the last 10 years, it doesn't do that ever. So sometimes the market does irrational things and I don't want to sell out of my position during an irrational moment. That's why I prefer setting an alert. So I don't set a stop loss. I set myself an alert. So I'll set an alert at 150 and I'll be like, okay, I want to know if my stock dips. I want to know if my stock tanks, so that I can reassess, like, was my bull thesis correct? Like, am I wrong on this? Because I could be. There's times where I'm wrong. There's times where you're wrong. And we have to accept our defeats, right? We have to take our losses. But if everything was intact, everything was still good, that's a buying opportunity. I'm not selling out. Like, you'd be crazy to sell out. My newer positions, Tattooed Chef, I bought it. Anytime it hit under $20, I bought. Anytime it hit under 20, it went down to like 15 bucks. I was down a lot of money on it. And for me to sell is just foolish. I was just like, oh, I'm buying more during this time period. So stop losses are, in my opinion, not helpful and useful for long-term investors we look at it as from a business standpoint. People who use stop losses are traders, right? They're just trying to trade momentum. They're just reading a chart and hoping for the best. So I personally don't use stop losses. I use alerts. All right, so that's kind of concludes our session for portfolio construction management. Today, we get to ask questions that you may have when it comes to constructing portfolios, maybe the environment that we're in. Any questions that you guys may have, feel free to start shooting them. And remember, the more questions that you guys ask, it helps not only future investors who are going to be watching these recordings for the next year or so, but it will also help the other current investors as well. Yeah.
Okay. So, what brokers do you suggest to use as for your alerts? I know, like you said, some brokers don't use the alerts, or which one? Is there a certain one you recommend more than others?
Yeah, I personally just like Fidelity and Charles Schwab. I just opened up a TD Ameritrade, just out of curiosity, if I wanted to create another account I thought about doing an options account, just like calls and puts, just for fun. But yeah, Fidelity and Charles Schwab, they're kind of just stable, consistent things. That's it. Give me alerts. I think you can also use the iPhone app too, the stock app. It might be able to, it might not, I'm not really sure. But I use it.
Okay.
Yeah.
So to get another portfolio, from what I've understood, is I need to open up another account. I can't really have like multiple pages in one account. You know what I mean? Is that not the case?
I'm not sure how it works with other brokerages. Are you on Fidelity too?
I use E-Trade,
Okay, E-Trade.
and I'm still learning. I pretty much know the platform. I'm trying to. I'm setting alerts. For some reason, it won't alert me. But I've thought about like separating my different stocks, but how to do that?
Yeah, yeah. I'm not familiar with E-Trade, unfortunately. But sorry, what was your question again? Going back, just totally blanked.
So what you're saying is to separate my portfolios, I need to have different accounts
Oh, that's
or
right.
different brokerages. Because something that that I want to avoid, but I don't really know why I'm avoiding it, is like I sell a stock, it goes into, it becomes cash, it it needs to settle. And I kind of feel like if I have multiple brokerages, I would have to send it back to my, I don't know if this is correct or not, send it back to my bank account, put it in a different brokerage. You know what I mean? And I think the way the brokerages make money now is off of fees because they're not making commissions, I think, anymore.
Yeah. Yeah. So this is what I do personally. Here, I'll show this to you. So this is my bank, right? I bank with Chase, and I have Charles Schwab, I have a Robinhood, I have Fidelity. I have different, so you can do multiple things. In my Fidelity, I have 2 accounts. And so it says account 1 of 2. So you can create multiple accounts in each brokerage. The purpose, so big question, why do I do all this? For my emotions. This is why I do it. My speculative and growth portfolio, I don't even want to hold the app on my phone because if the app is on my phone, I'm going to click it and my emotions are going to get tied to it and be like, oh, like I'm down a lot, or I'm going to get greedy and be like, oh, this is going up a lot. So I don't like to touch my growth. And so that's what like I know what growth stocks I have. I'm not looking at the actual portfolio. I'm keeping up with the companies, but I want to detach myself from that. So that's why I have a completely different account. And then like over here, my Fidelity is kind of just my like core positions, my retirement accounts. My wife and I's retirement accounts. And that I don't mind looking at because it doesn't fluctuate too much. So that's why I do that. I also have a crypto account and I don't look at my crypto because crypto is very volatile. So that's a whole nother thing. So I just keep things separate for emotion's sake, because I understand like emotions really can screw us all over. We can know everything, but your emotions will make you make a bad decision. So I take it very seriously of how I manage my emotions in the stock market. That's why I write journal all my investments. I have different investment accounts just to control my emotions. Setting alerts, the purpose of all of it is emotion control. Yeah, Chuck.
What you just said for us having different accounts, wouldn't that be playing to a good factor, like far as taxes wise, like if like you got like a short-term stock versus long-term stocks, would that help like separate like when you like for your taxes purposes and stuff like that?
No, it all is the same.
Or does that even matter?
Yeah, it doesn't matter. Like if you sell a stock within less than a year in any of the accounts, you're still going to get short-term capital gains tax, no
Right.
matter what account you're in.
Yeah, and that's why I thought of that because like say if you got like a short-term stock that you know you're gonna be short and
Yeah.
I guess you're
Yeah. So like, for example, I've pulled shorts on my Robinhood account and my Fidelity account. So like I pulled my short on my short position on Pepsi. It was on Robinhood. And the reason I use Robinhood is because it's so easy, right? So super easily accessible. All I gotta do is click a stock, swipe up. They have great user interface.
Hey, Justin, I got
Yeah.
a question. Hey, so for establishing your core stocks, like someone kind of starting out,
Mhm.
you know, I watched your video a long time ago on Facebook. I watch it, like go up quite a bit. And I'm looking at a lot of these stocks, these stuff that I would consider core, like they're kind of up there right now. So would you recommend kind of just like holding off and waiting for like a better time to buy, or just like parking it for now in those, and and then just and then building my portfolio from there? Like
Yeah.
what?
So do you mean your current positions right now?
Well, no, I don't have any current positions. Like I'm looking at like my portfolio, like all my money's in, like I got mutual funds and I got some like speculative things, but I
Mhm.
don't really have like a portfolio like we talked about tonight. And so,
Mhm.
like I want to establish some core stocks, but I'm looking at them like, man, these are a little high right now.
Mhm.
Would it be better just to wait it out till they drop down, or?
Yeah, so great question. So great question. For all of you guys who are newer in building out your portfolios, this is very applicable, right? You want to create your core positions, but you're noticing that those companies at the top tier, right? The Facebooks, the Googles of the world, they're trading at a higher valuation than they typically should. They're trading more rich than cheap. Um, so think about during the lessons today, whenever I talked about how we can't force an opportunity sometimes, right? There's certain times in the market where like growth or core stocks, right? Really high quality, they're just not on sale. So what you would do in constructing your portfolio is you're going to ask yourself, okay, where are the opportunities right now? Right. The last few months it was in growth. And so for you to set aside, let's say like $5,000, $10,000, however people's portfolios, let's say 10,000, just even number, because you want to set like 5,000 aside for core positions. So you're only going to use that other 5 to then start looking at building out different growth stocks, right? Like you're putting maybe 500 to 1,000 in some of these growth stocks that could potentially be on sale, just because that's where the opportunity's at. So yes, in theory, you want to be able to go down, build out your core positions. Yes, you want to build out and add on and sprinkle all these things in. That's a perfect world scenario. But market conditions is not always like that. So, for example, right now, like I'm looking at the entire stock market, I'm like, there's not much deals. There's nothing really compelling right now. So as an investor, what I've been doing, I've been selling out, taking some profits, very small profits. If there's a dip in some of these positions, I'm going to buy back in. But for someone who's building out right now, like I always say, like, yes, be uncomfortable holding cash, but also be patient like a shark. You got to be patient. And when those moments come, like you have to strike on them. Because sometimes those moments don't last long. There may be like 2 weeks to 2 months that like the really good deals happen. For example, in the growth stocks like XPong, there was only one day when it went down to $23. And it's just one day and then it bounced back. And it's probably never going to touch $23 ever again. So, yeah. So does that answer your question?
Yeah, that's great, man. Thanks.
Yeah.
Another question.
Hmm.
You talked about having your dry powder and that's bulk, and then that's consistency.
Hmm.
Is where would I want my bulk money stored? Do I want that in my savings account? Do I want that as cash in my brokerage? I think of consistency as like maybe I can automatically send so much every 2 weeks or every month into my brokerage, because I don't think my cash in my brokerage is making interest. And there's E-Trade does something called a sweep account, which I still don't understand. Like if I leave my money as cash, they move it somewhere. So where's the place? Because when the opportunity comes, you need it, right?
Mm-hmm. Yeah. So for example, like my Fidelity account, like my largest account, I have money just sitting in cash. It's not doing anything. It makes me uncomfortable, but it's just sitting there. And I'm building up that cash pile right now. Yeah. Oh yeah, another random tip that I wanted to show you guys, when it comes to like kind of the stock market conditions right now, because everything is overvalued, some people are expecting like, oh, things should crash, right? Like things should just crash. Incorrect. That's not how it always happens. There's stocks that get overvalued and they crash like that. You see a dip, right? You see that aggressive dip. This is what I call a stock crash because of price. This is a stock crash because of price. There's other types of crashes. Stock price gets way overvalued and it does this. And this is what I call a stock correction or crash based on time. So there's two types of stock crashes out there, and people don't understand the second one, and they're not better off because they don't know. So everyone's always wanting the stock price type of crash, right? Oh, this stock is overvalued, gets back to fair value. What this does, a stock crash based on time, is, oh, this stock got really ahead of itself. It needs time to grow into its valuation, right? This company needs to be able to grow and make more money to then fit its overvaluedness. And so this is a great time to also buy. Is that like, oh my gosh, like for example, like I'm looking at AMD, it's trading at around the exact same price as it was last year. Almost the exact same price, right, as last year. And I'm looking, I'm like, this company is now significantly better than it was a year ago, but it went way overvalued. And then it's currently crashing. It doesn't look like it, right? It doesn't look like it. The price, people are gonna look at it like, oh, it's only down 15%, but it's been consolidating. It's a time crash. And so this is a very helpful strategy to know. And this has helped me buy into some good companies, is buying during a time crash. So very important lesson. A lot of people don't know about this one. So other questions that you guys have? Yep.
Yeah, I got a quick one. Do you utilize your Roth IRA to, besides just using your cash to buy and sell stocks?
Do you mean like use it for everyday life, or?
Like, do you pay into it and then use that money, use that as like, to play with the stock market within just your Roth IRA money?
Yeah, great question. So why do I have like a Roth IRA? So for those of you guys who don't have one, it's a great tax advantage account. You guys can just Google like what are the tax advantages. You can only put around $6,000 a year into it. I don't put much into my Roth IRA because my philosophy is that money is better now than later, because I think that I can make better investments with my money now. And in a Roth IRA, your money is stuck until you're 59 and a half. Except the one condition. So I'm only putting a little bit into my Roth IRA because the one clause that I can withdraw from my Roth IRA without penalty is first-time home buyer. So you can actually use a part of your Roth IRA to help purchase a home. So for my wife and I, the reason why we're putting money into a Roth IRA is for our eventual home purchase. And that's why we're using it. Am I using it for my retirement? No, I have other plans for retirement. I'm not using a Roth IRA for my retirement, but I'm using that as a holding, as a safe haven, tax advantage safe haven for our down payment for our first home. Yeah.
Okay, it's more of a statement than a question. For the last year, since the pandemic, I realized, well, going through this course with you, I realized I've been playing follow the loser because literally I've been like chasing all the stocks that everybody was like the hype and everybody else says the next latest breakout. And I realize now doing homework and going back over my stocks that I have way too many stocks that have no education behind it, where now I'm actually going back and looking at them, really have no value to them at all. So I definitely appreciate you on that.
Yeah. Yeah. Thanks for sharing that, Chuck. Yeah, I appreciate you. My goal is for the success of all of you guys, like learning, like knowledge is power. But at the beginning of the course in session 1, I shared knowledge with implementation is power when it comes to stocks. And so there's so many people who invest out there who don't know what they're doing, but the goal is that this is generational, not wealth for you guys, but generational wisdom that can lead to wealth for your families and mine. That I'm going to teach my kids this, and you guys can teach people that about this. And yeah, more money is made this way, learning how to invest wisely. All right, any other questions? Don't know if Stephanie, Flavia, Carlos, Dylan, if any of you guys got questions.
So we can always go, how are we gonna access the videos? Are we gonna have access always to the classroom
Mhm.
and then like to the Facebook group and stuff like that?
Yep. So what does it look like moving on from here on out after we close out this first session is that you guys have copies, downloadable copies to the Google Classroom of every single session, so that you can watch it for a lifetime. Because this is your training wheels that you can run back through them, run through your analysis. And the Facebook group is lifetime access. That's where I'm going to be releasing all of my future content, is what I say, because I'm going to be teaching lessons there as well. Like, for example, I think the first thing I have on my list is like, okay, what do I want to teach my investor family? Selling cash covered puts, and how that you can make a few extra bucks if you're going to buy into a stock already. And yeah, so that's what it's going to look like moving forward. You still have access to me, just not in this way, like for all the members, but through Facebook. And I'll try to get back, like I said, in the quickest possible time that I can, depending on my life situation. But yeah. All right. Well, I think that concludes our very last session for session number 6 of the Stock Market Mastery cohort. Again, you guys were the first live class and the last live class ever. And so for all of you future members who are going to be watching this, I wish I knew you at this point, but nope, I'm going to meet you in the future. And I hope that this lesson and every single lesson actually does transform your life. Like, that's the goal, that these lessons would actually transform the way that you invest, so that you could make more money in the market to spend time doing the things that you guys love the most, your family, your friends, and the things that matter in life. And so that you don't have to pay fund managers, you don't have to worry about having your cash sitting around in a savings account doing absolutely nothing. But for the rest of your life, you know how to make your money work for you guys. And so appreciate every single one of you guys. And yeah, have a great night. I'll see you guys in the investor community group, and I'll see you guys around. Of course, Flavia. Thanks, Carlos. See you guys.